All right, well, welcome to this week's stock market review. My name is Bennett McDowell with traderscoach.com, and hope everybody's doing good out there as we get into summer. All right, I'm going to go through a few administrational items, and we're going to talk about the markets today. Basically, they're a little on the upside, not by much across the board, so they're kind of staying stable, so to speak. But we're going to take a look at the charts, and I kind of have an idea of what I think is going to be happening with those based on a probability forecast. All right, let me jump in and just go through these items I have to go through. First thing, I want to just tell everybody, give us a like out there. It definitely helps the channel. Pass this along to friends that are interested in the markets and see if they want to attend. All right, risks in the market. Yes, there are risks. We don't deal in a non-risk environment, do we? So you have to understand that the markets are all about probabilities. Whenever we trade the markets, we use a set of rules. I created a trading system with that, but it doesn't always win. All right, but it wins more often than not. That's the idea. And also, too, you keep your losing trades very, very small as compared to your bigger ones, or you win more often and keep your losing trades the same as your wins. So it depends on your model, and it depends on what you're trying to do. But there's a lot to it, is my point. It's pretty intense, and let us help you with that journey. That's what we're all about. We've been in business now for over 30 years, helping traders worldwide. You do want to use risk capital when you trade the markets. However, let me just point something out. Notice the banner at the bottom. I'm going to put this up in the comments area too, if I can do that. And basically, I've included a link and a coupon code. So this is a great opportunity for you guys out there that want to basically day trade the markets in the futures markets. The firm is a prop firm called Apex, and we're partners with them in terms of being an affiliate member. And what we like to do is actually trade the Apex accounts in our day trading room and so forth. And it's a great opportunity for you to get involved in day trading without really risking your own money. And they have a special going on right now if you use our link and coupon where you can get a significant discount. So really, it's basically a really nice way for you to tiptoe into day trading at a very low cost. You also get free data for the futures market too. So I think basically the special is roughly for a $250,000 prop account. That subscription price, I think, is like $19 for the first month and then $38 each and every month. But don't forget, you get free data. So I'm going to put that link up and share that for you guys. But that's a great way to trade the markets, and it falls in line with learning how to do it while you're not risking your own money. So it's all about risk control. All right, and then finally, run any of the ideas or stocks that we may look at here past your financial advisor to be sure those are suitable for you. That's kind of super important as well. All right, a couple books I've written on money management might be a good place for you to start if you're new or need help in that area. My new book, The Art of Trading, published by Wiley, is coming out this year, and we just finished it, so it's all set. And then I have the Elliott Wave Technique Simplified, published by McGraw-Hill, and that is a really good book on a form of technical analysis called the Elliott Wave. Anyway, I'll put a link up in the area down below for the recording, but also too, you can go to our website and check that out. All right, I'm going to go full screen here and open this up a little bit more for you so you can see it. All right, so some of the reports coming out for the remainder of this week. All right, so we have NBA mortgage apps. They're not doing so good on the mortgage apps these days. I'll go over that in more detail in just a bit. The employment report, PMI, we had quite a few reports come out, ISM and EIA. Tomorrow, but no FOMC this week. All right, tomorrow we got international trade in goods, jobless claims, natural gas report, productivity costs, Fed balance sheet. We end the week Friday, June 7th with the employment situation, and everybody's going to be looking at that. Wholesale inventories and Baker Hughes rig count and consumer credit. So I think actually we're going to be watching that employment situation report. I think that's going to be something that pretty much everybody is going to be looking at. All right, let me enlarge this for a little bit so you can see that better. This is the inflation over a decade. So when we talk about interest rates, basically what the Fed has been aiming to do is keep it at the 2% level, or get it down, I should say. So here's the 2% level right here. All right. So we drew a somewhat straight line. I'll try to do my best on that. All right. We get kind of a line here. And again, that's the 2% level. And we got up in 2022 to 9%. All right. Now they've been bringing it down. You had all the rate cuts, right? Interest rates went down. And they've been struggling to get it below 3%. I think it's at 3.2. All right, right around that ballpark there. And it's they're basically going into this year, folks were thinking 6 rate cuts. But what they were thinking is that they looked at that when basically, it was a straight dive down. So they said, for sure, we'll get down here. We'll be able to drop some rates this year. Well, it kind of went sideways and got what they call sticky. That's the term they like to use, sticky. And it's hovering in that 3% range. And it's not down to 2%. So they haven't lowered rates. That's why. And some people now think they won't lower them at all. It's an election year. So we'll see what happens. I wouldn't be surprised if they lower it. If the market sells off any more dramatically than it already has, you may see them lower it to create some type of optimism and thus stability in the marketplace. So I certainly could see them doing that. But we'll see what happens. All right. So that's kind of what's keeping the interest rates kind of stuck there. We're going to look at some charts. We use our software. Like I told you before, we've been doing this for a long, long time. I create software that I use on trading the financial markets. We have price related software called the ART software. We have scanners, and we have risk control software. I'll put a link at the bottom if you're interested in getting going on that. All right, here's the S&P 500, and I guess I'll just start out with that right here, and then we'll look at some of all the markets here. So the S&P got up to its target zone, and it's been coming down a little bit. We're not so sure it's done getting into the target zone, so we're going to kind of see. It's a little too early to say. But this is a target zone that we have been watching for quite some time, and it did hit that. So no surprise there, but you can also get more activity into that target zone as well. So it doesn't necessarily, mean that that's it. NASDAQ has not quite hit its target zone. NASDAQ is a powerful market, and basically, I think that you won't get a significant top on the overall markets until the NASDAQ does it. And so has it been close enough? Well, not really. It's got to kind of get a little higher in there. It's possible. Only 15% of the time the markets collapsed before reaching a target zone based on the fib extensions. 70% of the time they hit this area here. So if you're a probabilities guy like me, okay, I go with the probabilities. And so that target is about 17,530 up to 18,957. So it's a zone. Longer term, if it accelerates and goes even higher, we could get into the 19,260 to even a little higher, 24. So we'll see how that works out if the long-term play is stronger than the short-term play. In the meantime, we had predicted it was coming down into a target zone between 16,000 over on this chart here. This is a target for a profit-taking pullback before it surges forward. So I kind of think we saw that in the markets, experienced it over the last couple of weeks. All right, on Bitcoin here. Bitcoin, we're bullish on Bitcoin. It's surging today. It is currently right around, this was taken on Sunday, but now it's at 71,000. So it's been going up quite a bit. And we expect it to get to 89,000 to 110 on this next run up. So basically, if you're holding Bitcoin, keep holding it. All right. And that's kind of where we're at now. So as traders, we will probably dump some of it in this area here. But for right now, we're going to hold it until we get to that target area. And it does seem like this profit-taking correction here is now over. It's got to go a little higher before we have a much higher confidence level that the correction is over. These things, you know, what can happen is on these corrections is you can think they're over and then they trickle down and go back up. Nonetheless, whatever happens with Bitcoin at this particular point, even if it goes down a little bit more from here, we're bullish long term. And I actually think this is a bottom now in here. So I'm pretty confident we're going to go up from here. All right, on the Dow here, you can see where we hit the target almost twice. Now, there's something in technical analysis, everybody knows it. It's called a double top, right? And do we have that? It's possible. All right, we're going to have to see. I'm not going to call a top in the markets yet until that NASDAQ gets to its top, because I think that NASDAQ will fuel the market back up, even on all the other markets, into the wave 5 target zone. This is a big deal. All right, once we get in here, all right, we're pretty much at the end of the bull market that we've had fun with for quite some time. And at that particular point, we will go into what I would think is a fairly severe bear market, which will be a wave 4 on the weekly charts, which are the long-term charts. And that means the bear market could last for, you know, a year to 3 years, depending on how it unfolds. But what we're looking at here is probably one more high, I think, into this wave 5 target zone. Now, if that does not happen and the market continues to sell off, you got to keep it. We'll keep an eye on this for you. This is a key level of support right here. We go below this here, and then the likelihood of this being a double top increases dramatically. Okay, so we're going to keep an eye on that for you. And that price is right around, I'm just going to throw out a ballpark price around 32,000 and some change. It's below, I think it's below 32.5. I'll look on the exact charts. All right, so somewhere around in there, we'll be concerned. I'm not concerned yet. Okay, that could change, however. But in any case, here it's been. I kind of feel based on the NASDAQ, we're going up one more time. All right, so basically we had a retracement up here, and then we should have one more move down, and that should pretty much end this retracement before it starts to head on back up. This mark here is the 37,000 mark. This is not the 32,000 like on the other chart. So this is basically saying probably one more dive to the downside, and then we should either see a movement significantly back up, or if the top is in, we'll see a more significant move down. All right, in the real estate arena here, let's talk a little bit about that. If you have any questions on the market, feel free to ask at any time. All right, so Case-Shiller Index versus the CPI. I show this every week. It is a new chart every week, so I don't think I'm showing you the same one, but it looks the same. All right, Case-Shiller, all right, CPI down here. So the Case-Shiller is in red. The CPI is that black line under it. And we go back to the 1970s. So in this chart here, what we're looking at really is the performance of the Case-Shiller versus the CPI. And the Case-Shiller is basically representative of the average home prices in America for residential real estate. So this is not commercial. This is residential. And as you can see, if you go back to the 1970s, the Case-Shiller Index has always been above the CPI. But it varies in the distance above it, all right? And usually when you get an excessive distance, you have a bubble. And that's exactly what occurred here, all right? And of course, everybody knows this was the financial crisis. And the financial crisis technically started in 06 and started to break down in 08. So really what happened is it kind of stayed elevated, home prices, all right, before it broke. And almost 2 years. All right. So it kind of went up, crested, and then went down. And that process of the cresting took about 2 years. Now, we all know what caused it. It was basically securitization of mortgages, which means that what the industry had changed from one of making loans to really trying to create profits from securitizing the mortgages out there. And so what they did is they lessened the qualifications for a mortgage, and cared more about basing the mortgage on the home's value. And during a bull market like we saw here, all right, that was really good. And it was very easy to get a mortgage. So you had everybody, the interest rates were pretty low. So everybody ran in to get these mortgages, and home prices took off and got bubbled or far away from the CPI. Then we hit a recessionary time. People lost their jobs. They weren't qualified for the mortgages to begin with. And the market came down. We got into a recession. It turned around again once they lowered rates, and all the excess was washed out, which is healthy. Okay, that's what corrections are. Corrections are not bad. They're healthy. They wash out the market so we can start anew, right? That's kind of what they're all about. So they're actually, you don't want to tamper with those. You kind of want to let the free market do that for us. When you go through one and you get caught with it, you learn, and the next time it happens, you don't get caught quite as bit, right? So that's what life is all about, learning from our mistakes and so forth. So in a case like this, now we've gone up again. We've had COVID, we had low interest rates, and now look at where we are now. So this is an unprecedented distance away from the CPI, unprecedented. And so this bubble is twice as high, I would say, by visually looking at it, than this one. Maybe not quite, but you know what I'm saying, pretty close. So you can see that inflation has also increased, okay, over the last couple of years. All right, so we've, that's been reflected on the CPI, but home prices have continued to go up due to the factors that drive home prices, like supply and demand and interest rates. So a lot of people are holding on to their homes because they have a low interest rate mortgage, and they kind of don't want to buy or roll over to a new home and have to get another mortgage at a higher interest rate. So they kind of cling on. Well, things have changed this spring, and I'll go over that. There is more inventory coming into the market. And until you get that inventory coming in, you're probably not really going to see the markets come down. The housing market come down. So also too, recession could cause that. So one of those two things will cause that. But ultimately, if you have a recession, people lose their jobs. And what do? They have to sell their home. So that increases the inventory anyway. So that's kind of what I think. This is a great graph to look at for the overall housing market. This came out today. Dow Jones reverses lower after jobs report miss. All right. And of course, NVIDIA, it's more record highs. All right. So I'm going to read the bottom here. The Dow Jones Industrial Average reversed lower Wednesday. It was up higher, reversed now after a weaker than expected employment report from ADP. Among the gainers were artificial intelligence giant NVIDIA hitting more record highs, and CrowdStrike, which soared on the stock market today following earnings results. So there you have it. So I don't think the market is done yet, but I think, we're in that toppy territory. All right, on the interest rate situation, the average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances less than $766,550 increased to 7.07 from 7.05. It had come down a bit, and now it seems to be going up. Applications to refinance a home loan fell 7%. That's a big number from the previous week, and were 5% higher, however, than a year ago. Mortgage applications to purchase a home dropped 4% for the week and were 16% lower than a year ago. That tells a story right in itself. So basically what they're saying is, home mortgages for those first-time buyers or anybody buying a home is down 16%. However, refinancing a home, taking out a HELOC loan, for example, accessing cash that you may have in these higher areas of the real estate market in terms of prices, that was 5% higher, than a year ago. So basically, people are taking out money from their homes to offset perhaps the higher interest rates and cost of living that they are experiencing. Not exactly, a healthy situation, I would say. All right. And mortgage interest rates last week moved to the highest level since early May, and that pushed the mortgage demand lower for the second straight week. All right, so there we are. Okay, kind of interesting. All right, this is just a question that was asked in the end of May here. Mortgage applications dropped again. Will home buyers return to the summer? Well, now they've gone back up. Okay, so it dropped down and now it's going back up a little bit. So it's teetering back and forth. This is kind of an interesting chart here towards the end of May. I pulled these off the internet, and basically this upper line here, let me just grab this blue line here, is the current 2024 season. And basically it's taking roughly 32 days, okay, to sell a home as an average, okay? Don't forget, real estate's very local, so it depends on your area. Some areas are doing really well, like in certain parts of California, doing really well. Texas, some areas in Texas are not. Florida is starting to diminish as well, so it's changing locally. But in any case, if you go back to earlier years, like in 2022, this same period, it took about 20 days. So it's almost 33% longer to sell a home today than it was a few years ago. Kind of interesting, right? All right, now if we go to the next chart, this gives you 3.2 months of supply. Okay, so this is talking about the supply available. So this year, okay, we've got 3.2 months, but in the previous years it was lower, which means that houses were selling faster. Okay, so now they're not selling as fast as they did in previous years. And I kind of think we all kind of know that anyway. All right, this is kind of interesting. Price drops. So notice back in the go-go years here, okay, there was basically quite a number of a low number of people coming down in their prices, whereas now it's at 6.4%. So basically, you know, you had overbidding back then. You didn't. You had, even if the house was a little overpriced, people were paying for it. Mortgages were low, but now you're getting a situation where people are having to start to negotiate, and you aren't getting that situation quite as well. So basically, when this type of reversal starts to happen, you start moving from a seller's market to a buyer's market. I don't think we're quite there yet in all parts of the country, obviously. I don't think you're there in California yet, for example, but I think it's starting to change. We'll see if there will kind of follow through, okay? And let's see what this is. Average homes sold for 99.5% of the final list price. So back in 2022, when you had the overbidding, it was 100% and then some. And then now it's, you know, down about 9.5. Okay, let me just erase that for a second. 99, so you can see it. 99.5. All right, so that's down at 0.6% almost, or actually 5 here. All right, so that's kind of telling a story here. And demand index now, this is people actually out shopping for homes, is low, okay, minus 12%. So the demand's not there, okay? So your transaction turnover is not going to be that high, even though prices have remained high. So for transactions, what this is starting to show, I think, is that for transactions, all right, coming to the marketplace, what you're seeing is it's taking longer to sell, all right? And basically, people are going to have to negotiate, whereas before, you didn't have as much negotiation. All right, inventory has been coming up this year, and that's what this is showing. All right, so back in 2021, inventory, of course, was low, and now it's coming back up quite high. So that means, of course, when inventory increases, home sales will, prices should come down. So we may be starting to see that particular situation developing here. So when it's a seller's market and you have a situation, you have low inventory and prices remain stiff. When you have more inventory, that's more competition for selling your house. And if you have low demand, you have to be very conscious of that. Okay, so you really have to price your house correctly in this market. So just a summary here, the average 30-year rates are below the October 2023 peak by 8%. All right. But housing affordability is near record lows due to record high income home prices and still elevated rates. I think that basically says it all right there. All right. And two says it all too. Housing affordability is still a huge challenge for home buyers, especially compared to the past several years. Rates more than doubled and prices are up around 40% just from 2019. 40%. All right. So this is making it really difficult for people to buy homes these days. And I think we kind of can see that certainly in some of the graphs that we saw before. And you know that from your neighborhood, right? And what's going on. So if we go into a recession, okay, I think that's where we could experience a problem. So we definitely got to think about that. All right, so that's all I've got for you here today. And what we'll do is, don't forget, we have client support in about half an hour. But very interesting times. Again, my overall thinking on the actual stock market and so forth is that it's too early to call if this is in a significant major beginning of a sell-off. Some people think it is. I don't. I think we got one more high coming. I think we're going to get into that target range again before the election. After the election, okay, all bets are off. Then we have to be really careful. So let's see what happens with this. If we have a major event come, all right, that causes some situation that causes the market to sell off, it still has to go through those support levels. And so keep coming here and we'll watch those. And if they do, all right, we'll sound the alarm. Otherwise, anything that we're seeing here is a pullback in still an ongoing bull market. So that's kind of the wrap up for today. Thank you for coming. We'll see you next week. And hopefully I'll see you tomorrow at Stock Analysis Friday. Don't forget we do that as well. And Stock Analysis Friday is all about bringing stocks. I don't really do anything but apply my software and technical analysis skills to any stocks you want me to look up. So if you come there, I'll give you my analysis, my opinion, and tell you whether you should be long, short, out of a market. If you're in one already and you kind of want to know, where should your exit be? When am I going to know things are turning south? Definitely come there and I'll give you a price on what I think, a support price on what I think is important for your particular stock or market. All right, folks, have a good one. And we'll see you back next week. I'll put a little music on before ending. And again, we'll see you next week.